So we're looking at a 43% chance of two rate cuts in the next meeting. But bonds are at levels where they were on August 5th when we were at the highs there. And that was an 85% chance of two rate cuts back then. So this just proves what we've been saying, that it's really the floor that matters and not what cuts we're going to be getting this year. That doesn't really matter too much.
Yeah, no, exactly right. And I think for those that don't understand what the floor is, simply put, it's where the Fed is going to bottom out in the rate cutting cycle. Right now, it's around 3%. Um, and the Fed's obviously right currently at 5.25. So that's a little over 200 basis points of cuts over the next cutting cycle. That endpoint or that bottom is what matters for bond, for the long bond. Not so much, 25 basis points or 50 basis points in the next meeting. That's a little bit more irrelevant, as you can see, right? I know we have NFP tomorrow, Friday, right? So we're going to get some unemployment figures that come in that could very well move, very likely will move bonds. Now, the expected print is 4.2. The consensus print is 4.2. Actually, a decrease from the prior print of 4.3%. So literally anything that is not less than the last unemployment print is not going to be good for the market and will likely give bonds a push higher. We'll see what comes of it tomorrow, but ultimately, um, bonds are now at a juncture where we're looking at a 43% chance of two rate cuts. I don't know if we're going to get a 50 basis point off the cusp. I think it's a little aggressive, obviously, given unemployment isn't really running away in terms of what the Fed would consider that being, right? Like it's not really out of control, but I guess that we'll see tomorrow, right, where that really ends up being.
Well,
If it
also,
comes in
wouldn't that just kind of give a bad first impression to start the rate cut cycle off with a double cut? That would kind of show that they're panicking and that they might actually be late to the party, and the market might run with that.
that's very true. Yeah, so that there's a lot of factors that come into this. We do have that jobs report tomorrow. If it comes down at like 4.4 or 4.5, right? Whatever that may be, whatever it is, consensus is 4.2. But if it comes in at 4.5, right, then obviously, like, I think we're going to see an aggressive shift up in 50 basis point cut probability, right? Like the idea is then, okay, unemployment rate's actually going higher than consensus, and it's starting to, inch even closer to 5%. The Fed may have to start acting now, and that may be a signal the Fed is in fact overly restrictive. We think the Fed's overly restrictive, and we've been very vocal about that. But I think ultimately, labor market tomorrow, we'll get some idea on that, and then this likely gets refreshed tomorrow with that. All in all, though, what I was saying earlier was, and what you did say at the beginning of the podcast, we are back to the same levels that the in the bond market that required us to be at an 85% chance of a 50 basis point cut. Now we're at 43% chance. So hypothetically, if we did get a 50 basis point cut, that is not priced into the market. That is under majority right now. So if we did get a 50 basis point cut, that means bonds go up even more. So it's been our view ever since we put the bond trade on July 2nd of this year. So far, it's been a pretty sick ride up. But ultimately, bonds have our view was based on our models where bonds, excuse me, had a more asymmetrical risk profile where simply meaning they have more upside than they did have downside versus equities. So far, that's panned out to be true. If we take a quick look at the time frame that we have here, we track everything on a very simple time frame, and we'll overlay this to our pivot date when we put the bond trade on, and you'll realize here bonds have outperformed absolutely everything. Here, bonds have beat gold, of which both have beat the S&P. The S&P is pretty much flat since our pivot. Bonds are up over 10%. Commodities and Bitcoin are both down almost 10%. So there's about 20%, excuse me, of alpha between bonds and Bitcoin here, and bonds and commodities. So a lot of people are a bit concerned with commodities, right? Because they are a bit confused, I should say. And I think the key factor here is we've been trained, or consensus has been trained for the last year and a half, 2 years, that lower commodity prices means consistent and higher ramp or more considerable disinflation. And therefore, that's good for the market. Inflation's coming down. I think we breached that pivot point at least a couple of months ago, maybe in July, I'd say, where lower commodity prices are now bearish for equity. And the reason for that is we've gone past this point where it's not so much a sign of lower inflation, or I should say higher disinflation or accelerating disinflation, right? Weird thing to say, but that idea of accelerating disinflation is no longer just surrounded with this positive and robust growth story. Growth is still somewhat firm, but you're even seeing the labor market weaken now, right? And these are all just things that are happening in, cumulatively. You'll put together the picture that the economy is not what it was the last 2 years of disinflation, meaning disinflation going forward is likely going to signal or coincide with weaker growth or just weaker demand, right? And the sign of commodities falling isn't so much that prices are getting under control. It's more so the demand is actually diminishing at this point, right? And therefore, I think that if commodities are to break down below the August lows, I think you open up the door for lower equity prices. And if they really come crashing down, I think equity prices are really going to get hit. I don't want to say crash, but if we take a look at SPY, if commodity prices go back to the August through the August lows and possibly even further, I don't see why S&P can't go back down to Momo easily, right?
Yeah. Well, I mean, especially if we do go into deflationary territory, we shift from disinflation to actual deflation. And that's when the Fed is really going to start panicking and really pushing for more cuts.
Yeah, I think there's some runway there, though. That this is what I think is that's a very good point you bring up, because I think there's this war on social media right now, or on FinTwit, right, between being in a recession and being in a slowdown. And for months now, we literally said, I think both of us back to back have said, a slowdown does not equal a recession, right? Just because you're in a slowdown doesn't mean you're in a recession. And with inflation still around 3%, I think we're going to have to see a real hard smack to it to get that outright deflationary thing, right? The deflationary territory, right? Where it's net, we're actually contracting on CPI. However, I don't think that that's likely. More so, I think we're going to see something where, this slowdown continues until the Fed relieves some pressure. Now, is that pressure 2 rate cuts and things can normalize, or is it all 4 rate cuts, 5 rate cuts? Right now, the market is not pricing in a recession. Okay, so think of it like this: the stock market and bond market are not pricing in a recession. The bond market is pricing in the Fed bringing policy down to 3% in 2026. So 200 basis points of cuts over the next year and a half or so, something like that, right? That's not recessionary. For the Fed to bottom at 3%, with inflation currently at 3%, but the Fed bottoming at 3% 2 years out from now, or a year and a half out from now, implies that we're in a slowdown. Likely a slowdown. Okay.
And it's also the rate at which they get to that floor that matters too. If they get there, if the market starts pricing in that they're going to be cutting a lot quicker, then that's going to start pricing in. That's more of a recessionary pricing, right? Even if the floor remains at 3%, but all of a sudden we're going to be at 3% in 2025, that's a recessionary pricing, right?
Yeah, because what ends up happening there is, for them to get to 3% in 2025, you have to go beyond 1 cut per meeting, right? So like there's a limit to the speed at which the Fed can get down to 3% without them having to breach that 25 basis point per meeting limit, or 25 basis point per meeting cut mark, right? For example, there's 8 meetings in a year, right? So that's for them to bring rates down more than 200 basis points from where they are right now, they'd have to go beyond cutting once every meeting, right? They'd have to hit the 50 basis points per meeting at least once or twice to breach that once specifically to breach 200 basis points in a year, but even more to get that rate lower.
Yeah.
So I
And we're
think
not
we're
going to
kind of,
see that. We're not going to see that
yeah,
unless we see unemployment rise much more.
right. Yeah. I mean, 50 basis points out of the gate, I think, again, that's a logic. That's something that's like, okay, that's just an insinuation that the Fed's behind the curve, right? So, okay, they're going to open with 50 and then do 25 after. But I think all the calls that I've been seeing and everyone claiming for 50 basis points on the open is just an adjustment cut. Like the idea of just like trying to get closer to the ball, but not really the idea that the Fed is going to cut 50 basis points at every meeting going forward, right? I think it's just the idea that, again, they should have cut in July, but they didn't. Now we're here in September, and they are almost in a position where, if the jobs report is strong tomorrow, I think you kind of erase the 43% um, probability of 50 drops significantly. Because again, like you said earlier, I do agree with the fact that if the Fed does open the gate with 50, they kind of insinuate that maybe there's something a little bit worse than they'd like to say outright. So ultimately there, I don't think, again, though, I'll bring this back to TLT, right? What we just spoke about a few minutes ago. If you're riding the long bond train, right? If you're riding bonds like we are, we don't really care about the next meeting, about 25 basis points, 50 basis points, because we saw the probability get cut in half for a 50 basis point cut, but bonds are still at the same price. Now, why is that? This goes back to the floor. The floor is at the same value, around 3% than it was in early August. It actually bounced up to about 3.25 and then came back down to 3 where we are right now. So that's what matters here, not the next rate cut, how much it is. Now, obviously, if we get 0 cuts at this next meeting, I think that's going to reprice. That's going to be, a problem. But I don't see us getting no rate cuts at this point. Again, the Fed has done crazier things. We'll have to see what happens. But my view and our view as a whole, based on our models, is that bonds have this asymmetric upside. I still think, like, look, depending on when you buy bonds, right? For example, if you bought TLT on the 5th, right, of August, you're break even right now. And maybe you came across our content on August 5th and you're like, oh, these guys are cheering about bonds, right? I bought bonds and I'm flat now. There's nothing, there's like, this is not great. This is not even, might even still be down a little bit, right? The idea of us buying bonds is not to just throw money at the wall and just buy bonds at any price because there's going to be some type of COVID event where bonds go up like 100, percent or whatever it may be, 50%. The concept here is that we want to be positioned for the cycle. Now, the cycle is immeasurable, meaning could TLT go up to 110? Is that where it peaks? Does it peak at 120? Does it peak at 130? I don't know. Nobody knows that. The idea is to get yourself in and ride the cycle until the exit signal appears. And we got the entry signal on the 2nd. We have not gotten an exit signal so far. So far, we're up decently in the bond trade, but the idea here is that like bonds will continue to go higher until something changes. So it's our view, perhaps you missed the bond trade, right? And you really want to own bonds. What would I do in that situation? Well, I would personally say, look, I'm not going to buy bonds at the top, but I'm also not going to wait for bonds to significantly break down. I'd be trying to put bonds on in a ladder, right? Like into weakness, into maybe tomorrow's NFP print is, 4.1 or 4.2 and bonds dip down to mid vamp, bonds dip down to lower vamp. I doubt that, again, they would go from here to lower vamp like that. But if they do, use those windows of opportunity. When our system pivots, the reason why, so we get some questions sometimes on how do you allocate money when there's a regime pivot? How do you scale in? And we just openly say we buy the close the day after the signal happens, just like the rules are illustrated in our daily quant deck, which you can get on our website in the members area. The reason why we don't really, we're less price sensitive when the signals occur in our in the quant deck is because we are at the beginning of the regime. Meaning, if we bought TLT here, or we bought TLT here, or we ended up buying TLT up here, right? Because the signal occurred 3 days later, right? For example, we were just bought in anyways. we're at the beginning of the cycle. It's when you come across this late stage, and some would say this is not late stage, but in terms of, I mean, we're up decently on bonds in a pretty aggressive fashion. You have to monitor this and really accept that, like, things aren't just throw your money at the wall randomly like you would at the beginning of a regime at this very start, where the upside is very skewed in your favor. As bonds continue to rally, they will continue to rally until something changes, but they will have become less and less favorable as they do. And I think that's something you have to understand. Like, we're not looking for TLT to get back to the COVID highs. There's no price targets here. The only price target we've ever outlaid on TLT was this idea that we should see 110, because that's just on interest rates. That brings the long end back down to 3.5, 3 mark. That's pretty much where we see what's going on happening here. Otherwise, we don't have price targets at market.
Yeah, there's a good lesson to be learned from this, because there's so many people on X that there's two camps. There's people saying we are already in a recession, but it's just not a technical recession. It's not classified as a recession yet, but we're already in a recession. And then there's the camp of unemployment is still fairly low. The labor market is still tight. We're not in a recession. Growth is going to rebound. So there's those two camps, but both of those camps are looking too far ahead. There's too many nuances and shifts that can happen before we even get to any of those camps. Right now, we're in the middle. We're not in a recession. We're in a slowdown. And just looking at what's in front of us in terms of the cycle is we've got rate cuts on the horizon. We've got growth slowing. We've got disinflation happening. Unemployment is rising slowly, but it is rising, and job openings are decreasing. Like, that's what's happening right now. That's what's in front of us. And that's what we trade and stick to that cycle, try to ride these cyclical waves in bonds and equities. That's what's in front of us. Not a recession right now. It's too early to call for a recession and deflation and all that crazy stuff. There's a lot of things that can happen before that happens. And also, there's no growth rebound just yet. If there is a growth rebound, our system is going to pick it up. But at the moment, we're kind of in this middle ground, but the odds are looking that we are heading towards a recession and deflation. But there are still quite a few dominoes that need to fall to get to that point.
Right. And it's important, I think, to follow up with what you said there, that our system is going to look ahead, right? It's not going to be anchored on the most lagging parts of the economy, like employment, right? By the time the employment figures come out, and I put up a post about this earlier, I think today, or was it yesterday? Either way, simply put, realistically, this is what happens, right? You have job openings, which is a signal of excess labor. What's going to happen in a contraction or a slowdown is the job openings are going to fall, okay? Because what's going to happen at the start is employers are going to say, well, we don't need this many job openings. Forget about firing people. That's not even on there. We'll just cut the job openings because we just don't need that much labor. Then what's happening is like, okay, well, we got rid of the job openings. Now we're faced with continued pressure. Well, let's see if we can optimize the workforce. And you start getting marginal layoffs, like stuff, if it's small downsizing here or there, you don't really get the rampant unemployment. And you see this slowdown in hiring, right? And these moderate layoffs. What ends up happening then is you see a complete halt in hiring and pure layoffs. And then you don't really have that offset where you're adding jobs versus negating jobs, right? You just have job negation. And in that process is what's considered the real recession. Now, the problem with this whole dynamic is if you wait until you're in the mode of just job negation, where you're just outright firing people, that's like a last resort opportunity where it's just straight firing, right? It's crisis mode. When companies are going around just laying off everybody, right? It's not because they think like, oh yeah, we're just going to lay off everybody and we'll just fix our company and we'll be okay. It's like most of the time people do the most uncomfortable things when they are forced to do them. And when they're forced to do them, the odds of them being easily fixed, with a rate cut, is not realistic. So there's this margin where the rate cuts and monetary easing, per se, could offset some of this imbalance in the labor market or kind of rebalance it. But if you pass or go on too far, what ends up happening is you're now into this phase where everyone's on, fight to survive mode, and it doesn't really matter if the Fed cuts 50 basis points or 100 basis points, because we know there's at least a 6 to 8 month lag in the cuts anyways, right? So even if they cut, the conditions for them to shock through and pretty much ripple through the economy, it's going to take a while anyways. So the companies are still going to have to deal with what's in front of them today. So that's why it's very important that the Fed doesn't get too far behind the ball. And it's one of the reasons why pretty much all year long we've been advocating for this gradual ease into the cutting cycle, where now everyone seems to be like, why? We've gone from in March of this year, the Fed should not cut at all in 2024. Everyone was saying, we were out there saying not cutting in 2024 is a policy mistake. Now we're in this point where everyone's like, why didn't the Fed cut already? What's going on? Right? In Q1 of this year, they were saying the Fed needed to hike. Literally at the FOMC meetings, there were questions from reporters on why the Fed did not lift the rate. Now everyone's wondering why the Fed didn't cut the rate at least a meeting ago. And this is how this works, right? And when everyone's focused on the reasons why the Fed should have already cutted, or should have already cut, it's under this presumption that the Fed is somewhat by consensus behind the ball. Now, could we all be wrong? It's possible. Could the Fed have been right here to hold out for longer? It's possible. But you have inflation swaps at below 2018 levels. You have inflation at and soon to be below 2018 levels, right? Why? I say this all the time. Why is the 30-year yield why is it up here? Why is it at 4%? If we're looking at 2% real GDP, right? Let's look at real GDP real quick. GDP now, we can just pull this up. 2018 we're sitting around 3 to 4% real GDP. We're at 2 right now. Maybe this changes, but real GDP is below 2018 levels. Inflation is, right? So we take a look at inflation. Here's inflation. Inflation's at the 2018 peak. We're soon to be below. And let's look at the 30-year again. And when you look at this, you say, well, okay, all these things that would determine how well the economy is doing, they're all signaling like somewhat 2018-ish area, right? Everyone's like thinking, oh, we're in this 1990s 90s arena where the long end should be at 8%, 7%, the economy's booming. Well, the way I look at it is like, why is the 3-year or the 30-year not at 3%? Why is it at 4%? Is this just a drastic misprice, or are we missing something? Now, obviously, the market pricing in to some degree is going to be right to the idea that the market's not supposed to be at 3% right now. I think maybe it could progress to 3%, but where it's at right now, our models say, and based on what we're seeing, there is an asymmetrical situation where there's more downside in yields than there is upside. That's why the system is long bonds. It has been since July 2nd. Or the RQF, sorry, based on the system reading. So our portfolio is long bonds because the system has outlaid risk-off conditions that appeared on July 2nd. Therefore, it's very simple for us. If, in this case, interest rates come down to 3%, it would make sense. If interest rates from here go up to 6%, it wouldn't make so much sense, right? Because we just looked at all these indicators, again, inflation, real growth, inflation swaps, everything that's implying things are not, even where rates are right now, rates are pretty much a little too hot for what the market's looking at right now. I think that's why bonds have been rallying pretty hard. Maybe they continue to rally. But I think this is all something we have to adjust to and take day by day, as we always do, right? We're not going to sit here with a price target and say, oh, we're not going to sell bonds until the long end gets 3%. The 3% is an arbitrary number. It just is a whole number that lines up with 2018. It's just a conversation starter or a topic. It's not so much saying bonds need to go to 3% and then we'll sell. I think you guys are smart enough to understand that. And other than that, do you want to talk about and wrap this up with some Bitcoin? What's going on here?
I mean, Bitcoin seems to be acting as Bitcoin does during risk off. It's not really. Actually, it's kind of solidifying our slowdown theory that we're just in a slowdown. We're not in a full blown recession, because I think Bitcoin's going to sell off hard once it's determined that we're actually going towards a full blown recession.
Yeah, I agree with that, right? Like I think Bitcoin, the fact Bitcoin's been holding about 50K this whole time is just a sign that, like, look, there's this idea that everyone likes to say the recession starts before unemployment breaks out. And that goes back to what I said earlier in the podcast, the idea that the economy becomes irreparable after a certain point, right? Or unrepairable, like right where you can't really stop the deterioration of the labor market. I think you're exactly right there, right? With Bitcoin. Bitcoin is just another signal at the moment that you haven't breached that point just yet, because you haven't really hit the liquidity trap where there's this exit liquidity that's required. And I think that's something you see in a recession. So this is one of these things that, this sideways pinned action. It's not really bullish, but more bearish, but not really crisis telling at the moment. So just another thing for the slowdown camp, as you said. All right, guys. Thank you again so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com, where you can access all of our models on a daily basis in the members area.